Hello and welcome back to the course. In this video, I'm going to take a look at a pattern. This is the 1-2-3 pattern, and there are variations of this. Elliott wave traders might recognize this as an ABC pattern, or depending on where you are in the wave count, something like that. But really, I'm looking and I'm opting more for a simplistic approach. And 1-2-3 patterns are essentially three different levels that get drawn out, and the higher the time frame, the more important they are. Typically, it's a way to follow a trend, and quite frankly, it's probably the simplest way to trade. And a lot of bigger traders will do this. Now, you can't over leverage yourself because you have to be able to take a lot of back and forth trading along the way, but eventually, if you have a trend, it does pan out. So a 1-2-3 pattern is simply you get a move, like in this case, we broke down here, and then you get a bottom. It does work in both directions, but you get a bounce from there, and then you get a high, and then you get three. Now, three is a breakdown below the lows. Now, notice that there was a lot of noise here before eventually taking off, and that is where the not being over-levered comes into play, because that was a pretty wicked pullback you had here, but eventually you broke down rather significantly, and you're talking like 25 handles. Now, this is the weekly chart, so obviously that's a completely different story. Now, let's go into the daily charts, and you can see that there are 1-2-3 patterns here as well. We have 1, 2, starting from here, and then 3. We have trended nicely since then. We have pulled back, and then did it again. 1, 2, 3. It's really that simple. Now, the question is, what kind of stop loss do you want to use? Well, typically, you want to use the 2, but if you can use the start of the move, that's even better. Now, on a daily chart, again, this is going to cause the trader to have to use small positions, but you can also, again, use this on smaller time frames. So here we have 15 minutes, and you could have done 1, 2, 3, taken some profit, maybe gotten knocked out at break even. At that point, here's an hourly chart. It might give us a little bit more separation here. You can see that we 1, 2, 3 have continued lower. And this is a very, very simple way to trade. And a lot of times, traders who do this, they don't even use bars or candles. They just use line charts, because essentially at the end of the day, it really doesn't matter. This works in anything that's trending. Where you run into trouble is if you don't have a clearly defined trend. So here we have obviously an uptrend. But in this area here where it was going sideways, a lot of times what people will do is they'll take a moving average, and in this case I'll just put the 50-day exponential moving average, pretty common. And you see during that time period it was pretty flat. But here it was rising through those three different waves, three different potential 1-2-3 patterns. And a lot of times people would use that at least to give you an idea as to what you should be looking for. Very simple way to trade, but very effective.